The stock market does not ring a bell at the top. It is far more subtle and far more treacherous. The end of a great bull market is not an event but a process, and the public is always the last to know. They are too busy counting paper profits and listening to whispers of endless prosperity. But for the man who knows how to read the tape, what you now call your real-time price and volume feed, the market sends a signal. It is a flare in the dark, a final warning before the artillery barrage begins. To miss it is to volunteer for the front lines of financial devastation. To understand it is to be given the key to the escape hatch. This signal, like all truths of speculation, is not new. It is as old as the markets themselves, repeating with the same dreadful rhythm across every boom and bust in history. I documented these patterns for a reason. The stories are all there, written down for you in Reminiscences of a Stock Operator. You can find the link in the description of this video. Read them not as history, but as a map of the road you are about to travel, a warning of the ambushes that lie in wait. The patterns do not change, because human nature, the greed and fear that drive every tick of the tape, never changes. The signal I speak of is the key reversal, and it is the anatomy of a market top. It has three distinct components, and when you see them align, you are staring at the abyss. The first component is the bait, a new high for the move. After a stock has been advancing for weeks or months, after it has made fortunes for those who bought it early, it makes one final, glorious push into new territory. This is the moment of maximum euphoria. The newspapers and your modern financial television networks will be screaming with excitement. The last of the doubters are silenced. The public, which had been watching from the sidelines with envy, can no longer resist. They see the new high not as a climax, but as proof that the stock is going to the moon. They mistake the final act of the drama for the beginning. This new high is a masterpiece of market psychology. It is designed to do one thing and one thing only: create a stampede of buyers. The large operators, the insiders who have been patiently accumulating the stock at low prices, need an army of willing buyers to whom they can sell their immense holdings. They cannot simply dump their shares on the market. That would crash the price and ruin their own profits. Instead, they must create a spectacle. The new high is that spectacle. It is the beautiful lure glittering in the sun that hides the sharp hook. When you see it, after a long and sustained advance, you should not feel excitement. You should feel a chill. You should understand that you are likely witnessing the grand finale, not the opening act. The public sees a breakout. The professional sees a trap being set. The second component is the trap itself, exceptionally heavy volume. On the day the stock makes its new high, the volume of trading explodes. The number of shares changing hands is astronomical, dwarfing the activity of the preceding days and weeks. The amateur sees this and thinks, "Look at the buying power. Everyone wants in. This confirms the move." He could not be more wrong. This is the single most misunderstood signal in the entire field of speculation. That colossal volume is not buying volume. It is selling volume. It is the sound of the great floodgates opening. It is the large, informed operators distributing their line of stock to the tens of thousands of small, uninformed buyers who are clamoring to get in on the new high. Volume is effort. Think of it this way. If a man is pushing a boulder uphill and the boulder is moving swiftly, he is applying consistent effort. But if you suddenly see him straining with all his might, his muscles bulging, veins popping in his forehead, yet the boulder stops moving and begins to roll back on him, what does that tell you? It tells you he has met a superior opposing force. The market is no different. When you see tremendous effort, massive volume, but the price makes no further upward progress, and in fact begins to falter, you are witnessing a battle. You are witnessing the torrent of public buying being absorbed by an even greater torrent of institutional selling. This is called churning. The stock trades frantically but goes nowhere. The insiders are feeding shares into the market as fast as the public can buy them. They are happy to sell at these high prices, to pass the bag to the hopefuls. I saw this time and again in my career. I would watch a leading stock, the darling of the market, begin to trade in hundreds of thousands of shares at the top of a long advance. The tape, your screen, would be a blur of activity. But the price, after nudging to a new high by a fraction, would stall. It would fight, but it could not climb. I knew then precisely what was happening. The men who knew the true value of the company, the men who had engineered the entire move, were now quietly and skillfully getting out. The heavy volume was their exit. It was the noise that covered their escape. It is the second part of the reversal, and it is the sound of the trap springing shut. The third and final component is the verdict, a close at or near the low of the day. This is the confirmation. This is the market rendering its final judgment on the battle between buyers and sellers. The day began with optimism and a new high. The bulls were in complete control. But by the time the closing bell rings, the price has collapsed. It has given up all its gains and now sits bruised and battered at the bottom of its daily range. What does this signify? It is the irrefutable proof that the sellers have overwhelmed the buyers. The demand created by the euphoric breakout was not only met but was drowned by the supply from the insiders. There were no more buyers left to prop up the price. The professionals finished their distribution and withdrew from the market, leaving the public holding shares that are now falling under their own weight. There is no ambiguity in this signal. It is not a suggestion. It is a declaration. A new high shows the intent of the bulls. The massive volume shows the scale of the battle, and the close on the low shows you who won. The bears won. And they did not just win, they routed the enemy. To see this pattern and to hold on, to hope that the next day will bring a recovery, is the height of folly. Hope is a speculator's greatest liability. The market does not care about what you hope for. It cares about supply and demand. On a key reversal day, the tape is telling you that the supply has become overwhelming and demand has evaporated. To argue with that is to argue with gravity. I remember watching the leaders of the great bull market of the 1920s. Stocks like Anaconda Copper were the titans of their day. Everyone believed they could only go up. For months, they did. I studied their behavior, not their earnings reports. I watched the tape. As the market reached its zenith in 1929, I began to see the signals. A market leader would surge in the morning to a new all-time high. The volume would be immense. It felt like the celebration was just beginning. But I had seen this before. I did not join the party. I watched from my office, alone, studying the tape. By midday, the stock would stop rising. It would begin to churn, trading huge blocks of shares without advancing another point. Then, in the afternoon, it would begin to sag. The pressure was too great. By the close, it was not only down from its high, but it was often negative on the day, closing near its low. One stock doing this is an anomaly. Two is a coincidence. But when you see the leaders of the market, the strongest generals of the bull army, all exhibiting this same behavior, you are not witnessing a coincidence. You are witnessing the end of a campaign. You are seeing the smart money distribute its holdings across the board before the decline begins in earnest. The tape was telling me a story. It was telling me that the strong hands that had held these stocks up were now letting go. They were selling. And if they were selling, I had no business buying. In fact, I had business on the other side of the market. That pattern, the new high, the climactic volume, the weak close, gave me the courage and the conviction to place my massive short bets against the market. I was not guessing the top. I was reacting to the evidence the market itself was providing me. The key reversal was not a theory. It was a fact written on the tape, and it made me over $100 million. So, here is the unbreakable rule. This is not advice to be considered. It is a law to be obeyed if you wish to preserve your capital. When you have identified a stock or a market index in a prolonged, mature uptrend, you must watch for the three components of the key reversal pattern. First, you wait for the stock to make a new high for its current move. The crowd will be cheering. You must remain calm and skeptical. Second, you observe the volume on that day. It must be exceptionally heavy, significantly larger than the average volume of the preceding weeks. This is your warning that a major transfer of ownership is taking place. Third, you watch the closing price. The stock must reverse its early gains and close at or very near the absolute low of its trading range for that day. When these three elements converge, the new high, the climactic volume, and the weak close, the verdict is in. You do not wait for the news to explain it. You do not ask your broker for his opinion. You do not hope that it is a fluke. You act. You sell any and all long positions you hold in that instrument. You do so immediately, without hesitation. If you are a speculator and the evidence is clear across the entire market, you begin to establish a short position, starting with a small probe to test the waters. You have just been given the most reliable signal the market ever provides that the primary trend is changing. To ignore it is to choose to go down with the ship. The market has warned you. The tape has spoken. The rest is up to you.